Oh, there we go, another child who doesn't make a cent in the stock market and wants to teach me about CFDs.
Yes, I'm a child, and in this video I'm going to tell you why you must avoid CFDs. Hey, it's Dario and this is Divity Trading, a platform where we can share our best tips and tools when it comes to trading, investing or finance in general. You know, I see many videos talking about CFDs, how easy they are to use, how much money you can make with CFDs, how beautiful they are, and as usual, I'm not quite in agreement with these statements. And in this video, I'm going to tell you why. But hey, before we start, if you enjoyed the video, please leave it a like and let me know in the comments down below what are your thoughts on CFDs. Do you use CFDs? So before we start talking about the reasons why you should avoid CFDs, we firstly need to understand what CFDs are. They are basically an arrangement that you make with a broker where you gain money from the difference between the opening price and the closing price of the contract. They are derivatives and they replicate the underlying asset, such as a share or an index, for example. And because they replicate the asset, they don't give you the right to own the asset. And so we have already a big problem. It doesn't give you the right to have the asset. That means that if you buy a CFD that, for example, replicates Apple, the movements of Apple, you buy the CFD but you don't have the right to own the Apple share. But you know what, maybe you don't care about having or not the share of Apple, but let me give you an example where this problem comes out. What if your broker closes? What if your broker goes bankrupt? In this case, because you don't have the ownership of the share and because there is no one surveilling the situation, you don't have the right to keep the share or to keep the CFD. That means that if the broker closes, the CFD is gone and you lost all your money. So you don't just have the normal risk that there is in the nature of trading, you also have the risk of your broker closing. Whereas with pure shares, you don't have the risk because you own the share. There is a name, your name on the share. And if something happens to the broker, you can easily transfer your share onto another broker. Another major problem that I see is cost. And here many people tell me that there is no cost in CFDs or the costs are less than normal shares. Well, that's not exactly true. Let me just explain you. With CFD brokers, we have commission, which is completely normal. We have it even in pure shares. And you might say, yeah, but I saw some brokers that don't have commission, so actually the costs are less. Not exactly. Instead of commissions, some brokers have spread. And we see another major problem. CFDs are not regulated by anyone. So that means that the price of the CFD can vary between broker and broker, and the broker can choose its price slightly, of course. But that means that they can increase the spread, which is the difference between the bid and ask price. For example, if I want to buy an underlying, for example, again, Apple at 100, that means that with the spread I might sell it at 101, 102 or 103. With pure shares, that spread is much lower, and especially the brokers don't gain money from the spread. Also, in addition to commissions or spreads, we have the so-called swap, which is mind-blowing for me. Can you imagine that you have to pay to keep your shares or to keep your CFD contracts in the brokers overnight? That means that for CFDs there is no long term. You cannot keep a share long term because you're just going to pay crazy amount of money with swap. And another major problem that I see, especially for new traders, is leverage. Brokers who offer CFDs usually tend to promote or even highly promote leverage and the usage of high leverage. And I'm not talking about 1.5, 2 leverage. I'm talking about 10, 20, 30 leverage on the stock market. And that to me is just insane. I mean, with a market where the gap risk is so high, where every day there is a gap, you are leveraging your capital 10, 20, 30 times. Are you crazy? That's why when we talk about stocks, leverage shouldn't be used. Not even 1.5 or 2 leverage for me, especially if you're a newbie. That's because you have gaps, and gaps that go below or beyond your stop loss, and in that case you can lose a good portion of your capital. I had one guy asking me how he could have avoided losing $2,000 in a trade because of gaps. I just told me to not use leverage and to start using pure shares and not CFDs. Losing $2,000 because of a gap is a major risk. It's a major risk that you can have only when trading CFDs, because with pure shares you don't have that amount of leverage. You have maximum 2-3 leverage, not 10, 20 or 30. And believe me, important gaps that go beyond your stop loss happen, and when they happen you have to be prepared. And that means not risking, for me at least, more than 10-15% of your capital per trade. That means that you cannot invest more than 10-15%. So in this case you don't even need leverage, not even 2 leverage. And if I didn't convince you yet, let me just ask you this question. If hedge funds, if investment funds, and if professional traders don't use CFDs and high leverage, why should you? Why should you use this if you are a newbie, if you don't know how to invest in the stock market, if you don't truly understand the markets? Why should you risk so much? But also, why should you use CFDs when there is another option that is better, that costs less if you choose the right brokers, and that gives you less risks? So my advice here is to stop using CFDs, or don't even think about using CFDs, and start using pure shares. They have all the benefits of CFDs and even more. And so these were my thoughts on CFDs. But hey, if you enjoyed the video, please leave it a like and let me know in the comments down below what are your thoughts on CFDs, and do you use them to trade? And I'll see you in the next video. So, what is speculation in the stock market? Is it the same thing as investing? If I found a stock and I think it might increase its value, I can decide to make a thorough research on the company. I make a detailed analysis, technical and fundamental analysis, and I come to the conclusion that the price of the stock